maybe we can start, in the interest of time, just with a very brief introduction for the benefit of the audience.
Sure. Hi, everybody. I'm Sam Englebardt. I've been a media and content and technology investor for the last 20 years. In 2018, Mike Novogratz and I and a couple partners started a Web3-focused merchant bank called Galaxy Digital. And shortly after taking that company public in the summer of 2018, I started a division inside of Galaxy Digital called Galaxy Interactive, which is a traditionally structured venture capital business. We're on our third fund now and focus entirely on investments at the intersection of content and technology.
Hi. First of all, thanks for hosting this amazing summit and inviting me. So I'm Emma. I'm the CEO and founding partner of LongHash Ventures. We are a Web3 accelerator plus a VC fund based out of Singapore. So over the last 5 years, me and my partner Shikai, so before this we were both consultants from McKinsey, decided to leave the traditional space and join the crypto rabbit hole. Over the last 5 years, we've invested in more than 70 portfolio companies spanning decentralized finance, metaverse, and a lot of layer 1, layer 2 protocols. Excited to be here.
Hi everyone, I'm Sharif El-Badawi. I'm CEO of the Dubai Future District Fund. It's a new fund launched by the government of Dubai to invest in venture capital firms and in startups directly. We focus on the future of finance as a thematic pillar, and we also look at many other sectors and under the lens of 2050 economies and what kind of new innovations we can be investing in as a small country in emerging markets. I spent my first 12 years as an entrepreneur in California, then about 7 years at Google, doing things at a little bit more scale, and then the last 7 years investing in emerging markets.
Hi, I'm Jalak Jobanputra. Thanks for having me. I'm a founder of Future Perfect Ventures. It's a fund I launched in 2014 to invest in decentralized technology. It was after I went to my first Bitcoin conference in 2013 and just was sold on not only Bitcoin as a self-sovereign currency and the potential of that, but also the underlying blockchain technology and the prospect of using computing power and new technologies as a way to create more efficiencies and reduce the dependence on intermediaries. And so we're currently investing out of our third fund, we're a seed and pre-seed investor, funded companies like Blockchain.com, Blockstream, Abra, The Graph, Pether, which is now Aza Finance, and focus on the layer 2 or middleware space as well as early applications globally.
Excellent. So before we go into looking at maybe some of the differences in analyzing investments in the crypto space versus maybe the traditional industries, Web3 itself is a very broad term, so maybe we can talk about what are you most interested in this space. And Sam, maybe we start with you. I know you mentioned media and content, so where are your focus areas within?
Yeah, and in my case, I think especially as a venture investor today, and with Galaxy Interactive, we were launching a new business and a new venture franchise. I felt it was important then to really specialize. And I think in venture today, it's become an increasingly hard sector to be a generalist in order to launch a new generalist business, and you're competing against firms out there that have aggregated enormous amounts of capital, have enormous amounts of resources, and so on. And the world is just becoming more specialized as well. And so, like you say, Web3 is it's a broad area. I actually think of, for me, Web3 is one of several emerging technologies that are really important to what we focus on at Galaxy Interactive, which is actually interactive content and technology. So the way I think about the world is we've built a firm specialized in really immersive digital worlds and in a thesis around what's interesting and investable if you believe, like I do, that our digital and physical lives are really becoming increasingly connected and intertwined. And so really then that becomes, well, who's building the content that's going to matter in a world like that, when we really live and move seamlessly between our physical and digital lives, and what infrastructure tech is making that possible. So again, Web3 is one of the important technologies that I think will really matter as the world becomes more interconnected that way. But we've been, in terms of what I really focus on day to day, it's mostly applications which have been predominantly video games as the real like tip of the spear for the behavior that people are learning, and we now have generations of people that are really natively digital and natively gamers. And so, what do they learn, and what's the behavior that they engage in inside of those worlds? And then, what technology do they need to live the way that they want to? And how does their behavior drive technology trends? So it's sort of a virtuous circle that way. From there, it's really been for us predominantly game studios and content businesses and infrastructure tech driving those trends.
Well, it's very hard to follow after that. That's amazing. So I think maybe just for the context of the audience, right, how I think we like to define, right, Web 1, Web 2, Web 3. So Web 1 is about read. Web 2 is about read and write, because you're able to interact with some of the applications and whatnot. And Web 3 is really about read, write, and own. So own means you can leverage the new set of technology like cryptography, distributed ledger, to take back the control of data and assets, right? So I think if you look at Bitcoin, ETH, which are some of the Web3 native digital assets that you are really able to kind of own for the first time, as long as you hold a private key, right? You don't have to rely on a certain government to give you access or permission. And we think Web3 is gonna impact every vertical, right? Now, the first vertical it's impacting is decentralized finance, but after that, right, we've already seen the 0 to 1 impact of GameFi, metaverse, and we want to, in our view, we think in the next 3 to 5 years, you're gonna see Web3 impacting almost every other vertical, just like how internet. Right. So, but it just takes time because every industry has its own set of like adjacent technologies that needs to mature and whatnot. So I think for us as a Web3 native VC, we want to focus on the pre-seed to Series A type of opportunities, and we really want to focus on supporting projects that kind of espouse the Web3 spirit, which means permissionless, which means give people freedom, give people back the control in terms of the ownership of access to assets and whatnot. And I think interestingly, what happened to FTX, last week, kind of put this basic question back on the radar, right? Why are we in Web3? So yeah.
Well, I think I think about it a little bit like Sam does. I mean, to me, this is just a new technology and a kind of a tectonic shift that we're going through, similar to the internet one we went through in the 90s and then mobile sometime in the mid-2000s. And so it's very interesting to try to think about ways we can apply this new type of technology, which to me is mostly the decentralized blockchain component. Everything on the front end isn't very new, and we've been thinking about and developing things in those areas in interactive and gaming for a long time. If you think about Second Life type of environments and Minecraft, which is way, even before Web3 came out, and even virtual currencies, all the tokens and haystacks and things that you can buy in games. We've had those for a very long time. So now we're kind of trying to wait and see, and we split it into two, at least in the Future Fund. We have our Future Finance vertical where we look at the finance side of Web3, and then we have the Future Economy side where we look at the creative side of Web3 and how that's going to change creative economies or entertainment and behavioral changes on the consumer side of things. But I still think, or I feel myself that I'm in a wait and see time period. I have a lot of people on my team who are super enthusiasts, but we always go back to asking founders or investors, what is it that's decentralized about your pitch? Because they use the words, but then they can't answer that part of it because they're a company and it's still centralized. If it goes towards DAOs, then we're like, well, how do we as a VC invest in a DAO? And there's not really very clear answers to me just yet. And similarly, investing in a token rather than investing in equity directly in the company, we still have not been able to crack the rationale behind that when we try to estimate what a VC return looks like or economic returns look like. I have to still model it the same way that we model an equity investment, and we're not quite seeing a lot of traction just yet that justifies that. So far, I'd say it's almost the same as we're doing in equity investments, except unless it's an infrastructure play or exchanges. In some cases, exchanges make sense as an infrastructure or enabler. And it's really funny, Emma, like I grew up in a time when we called it Web 1.0 and Web 2.0 and Web 3.0, and 3.0 was not Web 3. It was a different translation. The meaning of that was that we were taking incumbent large industries and techifying those industries, as Steve Case would say. So for that name to kind of be usurped by a different community as something else is really funny for us, because we're still watching and trying to understand, like, what are the tangible ways we can get involved and help and support. And it seems like a lot of the community, at least the crypto community here in Dubai, tends to think, we don't need your money in the traditional sense, but I do need you to support this token, or to support buying the NFTs, and that will be our funding. But that doesn't work for an economic return for a VC. So we have to still figure that part out. And I'm excited to find out, but we're also very cautiously patient.
And I'd love to actually come back to some of the points you made about the difference in assessing equity versus tokens as well, but maybe Jalak, from your point of view on...
Yeah, so I started venture investing in '99. I was a TMT banker before that and worked on the Netscape IPO. So I've seen the evolution of the early days of the internet. And when I launched FPV, it was very much through that mindset of, this is exciting new technology that can give rise to new business models, can create more kind of equitable structures and more access to capital, more access to investable assets, better data security. So just like when I got into the internet, I was really excited about what it meant for education and healthcare and financial services. But also very cognizant of how long it took, or continues to take, for us to realize the promise. And so with a very kind of pragmatic approach that I started FPV, as a venture fund, we are, it's funny, we're a traditional 10-year fund. Still, a lot of funds have shortened their timelines and are now getting longer because they do realize it takes time to build. But we still have to return capital to our investors. And so when we look at any new investment, yes, I can get excited by the technology, but I really look at what's feasible in the next 3 to 5 to 7 years and invest accordingly. So in some ways, the technology, the innovation has developed much faster than I had originally anticipated. This is open source, it's global, it's truly borderless technology, so many smart minds around the world are innovating, but then usage hasn't necessarily followed, and I think part of the reason is, how many people really want to open up a MetaMask and then bridge between different tokens and platforms and be subject to slippage. And it takes a long time and a lot of effort to learn all of this. And so what we're most excited about, I'd say, is these Web 1 and 2 entrepreneurs coming in with their experience with user interfaces, both on the enterprise and consumer side, and bringing that expertise to this kind of back-end technology that has so much potential. So I think the next few years are going to be all about that at both the enterprise and retail and consumer level.
It's interesting because I find that a lot of the people in the crypto space that I've seen to have the most success, like a lot of them have come from the TradFi world. So it's interesting what you say, that even the entrepreneurs have, done successful Web 1 and Web 2 companies. You mentioned about user experience. Interestingly, from my friends who are gamers, I'm not a gamer, the ones that have played like the Web 3 games have said, like, they're terrible. They're just, the user experience is not great. So it's like the Web 2 games are great for gamers, the Web 3 games are great in the metas. I'm just wondering, how do we bridge that gap, and maybe not just to gaming, but more broadly about user experience in that next generation?
Should I start with gaming? We have a long ways to go still. Things are improving quickly, but I mean, in the gaming world, I think the benefit of Web3 so far, I would say, and of the games that have been built so far and released, and some of them have had some, a little bit of success. Some have had a lot of success for a short amount of time. I think we have not yet seen, and there is not today, in my opinion, a game out that's going to really stand the test of any meaningful amount of time. But the benefit of Web3 so far, and what we've had from a few of these moments in Web3 where you start to see what's possible with a new economic model, with a bit of an open economy, with the opportunity to own digital objects in a new way. Like all of those things, what's happened over the last 3-4 years, and it really has been in that short amount of time that the traditional game community, the great majority of them, 4 years ago, even three years ago, were unwilling in most cases to even have a conversation about the idea of blockchain gaming. I mean, I remember when we started Galaxy and had made a couple of Web3 game studio investments, and we'd get laughed out of the room by a lot of the publishers and a lot of the executives at big publishers that today and in the last year and a half or so, 2 years, have started popping up as angel investors in all of the cap tables of the Web3 games and studios that we're investing in. Most of these big publishers, many of whom are my LPs, have come around to at least recognizing they need to dedicate resources to figuring this out, and they're opening their mind to the idea that there's a real benefit to building and publishing and operating games from Web3 that they weren't willing to acknowledge previously. That being said, when you think about like the challenges of user experience with Web3 today, and including like one of the biggest ones, most of the customer service departments at all of the big game publishers will say, every day their number one issue is dealing with lost passwords, right? Kids who have lost their passwords, and it happens all the time. And anybody who has kids that play games, that is a benefit of centralized control and businesses. You lose your password, you're able to reset it, you're able to still own and get your stuff, or at least get access to the stuff that you're renting from the games publishers. That issue, like if you really think of inherent in blockchain gaming, and in one of the most touted ways that blockchain is going to impact games, is this idea you're going to own your stuff yourself, that they're going to be decentralized. That's one small but fundamental usability question that we have to solve. What happens when you have to explain to people that no, they've lost their key and their stuff is really gone? We have to tackle just the friction of how to even engage with that system in the first place. We need to figure out the toxicity that is currently the biggest issue in games right now. You're going to have to deal with, and I think we've seen it unfortunately in Web3 to date. Like it brings out a lot of the worst elements in certain people in the space right now, which is common with a lot of new technology and new innovation. You get people that are looking for an opportunity to scam and defraud you, and we're seeing a lot of that in crypto. That's another thing that we're going to have to deal with and figure out. How do we open economies? We've seen in areas as scrutinized and regulated as finance, that the financial opportunities that may present themselves in crypto bring out this really bad behavior. In a game, you could be the best game developer and designer in the world, make a game that has, where there has never been anything more fun to play. And yet, if people go in there and kids go in there and are ripped off and defrauded or scammed, no game will be able to survive that. And so we really have a lot to figure out before we can get to scale. And when I talk about how far we are, we've got to go from hundreds of thousands of Web3 gamers today, really, in terms of active users, to tens and hundreds of millions. And it can't happen until some of these things are solved. So we have a ways to go, and yet things are developing quickly. And fortunately, there's been enough indication that this could really be something that at least now the people that we needed focused on this 3-4 years ago are now really paying attention and excited about trying.
And I think it comes back to the point that, Jalak made earlier. It really is about patience in this space.
Yeah.
Like we are still very early. I'm actually interested, Emma, you made the point you invest in pre-seed stage, and then you're really just, you're investing in an idea and the founder, the team. when it comes to like usage and things, how are you thinking about that at that early stage in this sort of new area, and how does it maybe differ to analyzing a non-Web3 investment?
Yeah, that's an interesting question. I think it's actually no different compared to how you select early stage startups in Web2. Because for early stage, it's very much about idea and team, right? And I think maybe there's one more thing in Web3 that's very important is sort of conviction. Because in Web3, a lot of the things you're building are you're building the plane while changing the engine, right? Like what we did with proof of stake, change of consensus for Ethereum, right? And there's billions of dollars assets in there, and you're changing consensus mechanism in real time. So this have never been done before, and a lot of the business ideas in Web3 are like that. So if you don't have the conviction towards Web3 space, then it's easy for you to just try it out, because it's not like building an app in Web2 space, right? There's certain type of playbook, whether it's e-commerce or whether it's ride sharing, gig economy. There's certain type of formula you can try to apply. I think some of the business principles does apply no matter what type of business you're building. But you do have to live with the fact that some of the things you're doing have never done before, and you're just trying it out, right? That's the same thing with like cryptonomics, because if you look at tokenomics in 2018, that looked very different to 2020. DeFi summer, right? As a matter of fact, one of the projects we invested in, Fintech, in 2018, they were stablecoin. In 2020, they rebranded to Synthetics, and their initial tokenomics was very much modeling Bitcoin, because that was the holy grail, right? Fixed supply. Until DeFi summer hit, they were the first to introduce inflationary tokenomics in order to incentivize early participants. So a lot of things you're doing has to you have to be prepared to innovate. So for us, I think coming back to how do we select early stage projects, team backgrounds, conviction in the space, and the willingness to just pivot and learn and grow with the space. Yeah.
And you do that, you invest equity in the company?
We do both. We invest in equity depending on the business model, but most of the times we invest into SAFE plus token warrant, because we've made the conscious decision not to invest into CeFi, centralized platforms. We very much want to align into decentralized finance, decentralized platforms, or decentralized networks that has to have a utility for the native token. Yeah.
And Sharif, you mentioned as well the difference when you're looking at or tokens versus equity. How are you assessing the companies when you're looking, and what are some of the differences?
I think for us, or at least for me personally, I mean, I just cannot assess the business in any other way than we're assessing normal startups and equity investments. And I think it's still the same fundamental blueprint. We need to see what the exit economics are. We need to see sensitivity analysis on the market and how margins are going to look and the metrics of that particular business model. And we don't get those answers in the most straightforward way when we're talking to Web3 founders. And it's either we're asking, like we sound like aliens asking these questions. They're like, are you crazy? No, you just don't get the vision. We're like, okay, well, happy to get the vision, but can you just answer some questions? Or you have a data room, and it's like, no data room. It's like, it's just faith.
I think that's going to change now.
Well, it shouldn't have taken something like this for it to change.
Yeah.
And I think that's why that we're going to see hopefully a convergence to more disciplined Web3 founders and Web3 businesses, because fundamentally they are businesses. And if they're not businesses, then that's a different story, and they shouldn't be raising venture capital, right? If they're maybe a DAO or something that's more of a community, great, you know? Well, maybe you're accepting donations or some other way, sponsorships. But for it to be a venture business that is going to return venture returns, we have to analyze it in the same way. And that's where I don't think I've figured it out yet. In how, if I invest in the token, I'm going to get the same economics back, or have governance controls in place. And not that it has to be centralized, but governance can be in a decentralized world as well. And I don't think we've really created those frameworks yet, or at least, I certainly don't understand them. if they do exist, to me, I can't see the signal from the noise. Like, to me, there's a lot of hype, a lot of noise. We've seen this 3 or 4 times now, at least in the last 25 years, in other technology shifts. I'm very excited about the technology and the potential for it and the promise of it. And I think that's what the youthful exuberance we've seen in this movement is because of that promise. But have we seen the promise really play out yet? No, not yet, because most Web3 companies are centralized. And then we see what happens when a centralized, decentralized company doesn't have governance, because it skipped through that part because they had they had a free pass to skip through governance somehow. So I'm still patiently waiting, but I've already seen, many of us, I think, have seen some of these tech curves before, and I'm really excited for this to get shaked out and then really climb up as a true technology that's useful.
It's sort of a difficult thing about, and I used to work for Skybridge. I think many of you I met at Crypto Bahamas. So Skybridge had invested in FTX. It was a pretty convoluted relationship. Sam Bankman-Fried then invested in Skybridge, but it was at that era that we were getting, we were doing private market deals. It was, you've got 48 hours to turn this around. Again, you ask for the data room. Like, sometimes you would get one slide. And I feel that with crypto, because the crypto native people are like, oh, bro, it's the community. You've just, grow with us. It feels a bit WeWork-ish based on cult. And so in some ways, it's a challenging one to bring institutionalization to, but I think what I'm hearing is you've just got to treat everything like it has to be a real company. There has to be this sort of growing up stage.
What's funny is I think the last 2 to 3 years conflated 2 things happening at once. Web3 was coming into its own, and there was enthusiasm against that. But even the regular startup venture world was frothy and going out of control. We had a lot of tourist investors or new VCs coming into the game who hadn't been through a few downturns before. So when, on a 15-year bull run like that, prices just became outrageous, 20 to 100x multiples on revenue. So it wasn't just the Web3 world that was going crazy. It was kind of all of it together, and the 2 things kind of got mixed together. Now we're coming into a downturn, and hopefully we'll get clarity on both sides, because it's not healthy, even in an equity venture environment. What we saw the last 2 years was just out of touch. Like, that's just not how venture returns work. And we see even some sophisticated, hedge funds, private equity coming from Wall Street, coming down into venture, but don't know venture economics as well. And so they're overpaying for everything. It just screwed up the whole ecosystem. And now, I think we're coming back to a little bit more realistic look at the ecosystem, which is good for founders. It's not good for founders just to be in a hype market. I mean, as a founder previously, we didn't want to pump our valuations beyond our traction. But it didn't seem like the last 3-4 years, investors or founders were thinking that way. I think it's both sides. I mean, it was the same DNA from both sides acting in this manner.
Yeah, totally agree.
Yeah,
I'm glad you pointed out it's not just Web3. It's pretty much all the risky assets
the whole
out there.
market
Right?
just kind of went crazy.
Well, like a really interesting thing, I was thinking about this last week, listening to a panel from some of the great big institutionalized growth investors at Milken. And I thought to myself, here we have in crypto, this complaint has come back around that the crypto community is so full of scams and frauds and so on. And I was thinking to myself, going back 10 years, which I guess it's been 10 years since I first bought Bitcoin and started going to some of these conferences. And it was an interesting crowd, and the people in the space were different and fun, and half of them had face tattoos and whatever else, but they weren't they weren't really ripping you off. They were, for the most part, a pretty interesting, technologically authentic group of people. And through the institutionalization of crypto, in a lot of ways, what we saw is some of the worst actors from outside of the crypto space really come in and I think take advantage of this moment. And likewise with venture, I think, yes, there was definitely that community culture idea that tokens means no rights. And we definitely saw a lot of that. Some of that was necessary because nobody knew what to do with these things. And so we started creating these agreements and disclosing everything on them. And you'd read them and you'd be like, well, okay, I'm pretty sure we have no rights of any kind. But people thought that was their way around issuing securities. There were all kinds of weird stuff that happened. But for sure, the craziest, most reckless behavior in the venture capital industry with exponentially more zeros on it happened from the people that were supposed to be the adults in the room. These club deals and these things that were happening in the last 2-3 years, not just in crypto, but in venture broadly, and largely from a lot of the heroes of the investment world in these growth rounds where you're talking about not hundreds of thousands of dollars in a seed round where there really is nothing to diligence, but hundreds of millions of dollars in a round where you're just taking it on faith that the other person next to you went through the financials of this business that's supposed to be at its growth trajectory. Like, that stuff is so far and beyond anything that you see or ever, in my opinion, saw in really early stage seed deals. At least in those days, you knew what you were doing. You were making a bet on a person and a team, and you were diligencing them that way. This stuff, and then the negative signaling that has resulted from the institutional smartest people in the room coming in and telling the world that FTX must be fine because why would, and go down the list of people, put hundreds of millions of dollars and $2 billion this summer into something that so that's what, and I think to their credit, a lot of the growth people on the stage last week and in the industry at large have owned that and have started to say, okay, wow, all right, we do really need to look at things a little differently.
Yeah, I also want to add on to that. I think a lot of the Web3 principles starts from a good place, like transparency, community governance. It's supposed to provide a lot more transparency to investors compared to traditional, everything was made decision in a boardroom, right? Unless you're an observer or a board member, you basically have no say and you have no clue what's going on. Whereas right now in Web3, right, if you're truly going by the Web3 principles, the proposals are putting up in the forums, no matter who you are, if you're a token holder or not, you can go in, provide your input and whatnot. But I think as history tells us, right, it's often human grade, right? It's not the principles that's wrong. It's the human grade that's pushing those things off the limits. I think like late last year, there's certainly a lot of sense of traditional capital FOMOing into the space, right? Trying to get exposure to the assets and whatnot, and sometimes over leveraged and whatnot. But I think it's important to understand, right, what's pushing us towards that, right? Because it's like a pendulum, right? Even now, everybody's so scared, not wanting to deploy capital. Maybe now this is the best time. This is the bottom, right? So I think time and time again, we have to look at history and see whether it's the principles that's wrong or it's the human grade.
Right, but that never changes. Right. I mean, we saw this in the late 90s with the internet, the companies going public. I mean, when we talk about tokens, over the last year, we actually did very few deals last year out of the fund, even though we had raised a new fund and we're sitting on a lot of dry powder. One knew that there was going to be a downturn, didn't know it was going to be of this scale with this catalyst with FTX necessarily, but there are a lot of investors that were pushing entrepreneurs to come up with a token model that maybe it didn't make sense to have a token. I still think there are very few businesses where it makes sense right now to have a token. Now, I hope that changes because I believe in the incentives behind tokens, like co-ownership, but we're still in the very early days. And so to issue, it's almost the same as going public prematurely, or even worse, because you now have thousands, potentially millions of token holders that can bring the token to zero, speculate, and so we do about 20% of our fund in pre-sales. Sometimes it takes years to figure out what token model makes sense. But make sure that even though we're trying to make sure that the token makes sense and the incentives are aligned, you still have this very speculative element out there. And until we figure that piece of it out, I don't think the tokens are kind of fairly valued to the technology behind those tokens and the teams behind those tokens.
And unfortunately, we are out of time, and I have been giving previous panels grief when they have been running over time, so I have to play by my own rules here. But thank you so much for such an interesting panel, Jalak, Sharif, Emma, and Sam. Please join me in thanking my Web3 panel.
Thanks everyone.
Thank you so much.